In this video, we're just going to be having a look at what's meant by a dirty float and a sterilised intervention. First of all, what's important to note is that the RBA has little control over interest rates. Their only influence is really over the cash rate, and as a side effect, that will impact other interest rates in the economy. The RBA also only has some control over the exchange rate, and generally the RBA won't influence interest rates with the intention of trying to change the exchange rate. So even though a change in interest rates will impact the exchange rate, so for example, higher interest rates will attract capital inflow, the RBA won't deliberately change interest rates to try and impact the exchange rate. However, there is a form of exchange rate intervention, and we'll talk about that in other slides. So interest rate changes will impact on the value of the Australian dollar. However, the RBA does not specifically change the cash rate to try and change the level of the exchange rate. The RBA does not set a specific target for the dollar, and they do not use interest rates to try and achieve external stability or impact the exchange rate. But the exchange rate is a floating exchange rate, and the RBA can intervene through purchasing and selling the Australian dollar. So not by changing interest rates, but by buying and selling the Australian dollar to try and impact the exchange rate. So, for example, the RBA holds a stock of foreign currency of $36 billion. So they hold $36 billion of American dollars, yuan, yen, a whole range of different currencies, baht, rupee, which totals to around $36 billion. And they can use these funds, or in other words, they can either sell these funds and buy more Australian dollars, or buy even more of these foreign currencies to try and manipulate the value of the Australian dollar. So the RBA can enter the foreign exchange market and cause an appreciation or depreciation of the dollar by buying and selling this stock of their foreign currencies. When the RBA try and manipulate the exchange rate by buying and selling the Australian dollar, we call this a dirty float. So for example, if the dollar has depreciated, so there's been an excessive depreciation of the Australian dollar, this has its positives for Australian exports, but it's also negative because it can cause imported cost inflation, and it can increase the price of imported goods that Australians buy from overseas and therefore increase the CPI inflation. So what the RBA can do is if the dollar is depreciating, they can sell off some of their $36 billion of foreign currency and purchase Australian dollars in the foreign exchange market. So that will lead to a decrease in the shortage, that should say surplus of the Australian dollar. So that should help to increase demand for the Australian dollar, get rid of the surplus of Australian dollars in the foreign exchange market, and therefore prevent some of the depreciation or increase the value of the Australian dollar. So essentially, if the RBA want to prevent the dollar from depreciating or appreciate the value of the Australian dollar, they can buy Australian dollars with their stock of foreign currency and sell off their foreign currency. If the RBA want to decrease or depreciate the dollar because it's appreciating too much, and an appreciation can hurt our international competitiveness and reduce demand for exports, what they can do is they can sell Australian currency to put downward pressure on our exchange rate. So what the RBA can do is, because they have a stock of foreign currency, they can essentially buy more foreign currency and sell off their stock of Australian dollars to try and increase supply of the Australian dollar and reduce the value of the Australian dollar. This will help to increase export demand because the dollar will have depreciated and help to alleviate some of the problems that causes from like a high current account deficit and decreased export sales. So if the dollar is appreciating too much, they will sell off Australian dollars and buy foreign currencies. Basically, now we're going to look at sterilised intervention, which is another step from the dirty float. So, for example, if the RBA wants to increase the value of the Australian dollar, it purchases Australian dollars, and it generally will purchase these Australian dollars from Australian banks with its stock of foreign currency. So they will demand Australian dollars from these banks, and what actually that happens then is the banks now have less stock of Australian dollars and more foreign currency, and in essence their liquidity has fallen. So the banks now are less liquid because they have less Australian dollars, and what will end up happening is they've got less money to lend then to Australians, and that can cause the cash rate to increase. So as a byproduct of the RBA buying Australian dollars off the banks to appreciate the dollar, they have reduced the liquidity of the banks and inadvertently caused the cash rate to increase, which will have the same impact of tightening monetary policy. Now the RBA aren't trying to influence interest rates or try and influence the pace of economic activity. All they're really trying to do is influence the exchange rate when they implement a dirty float. So what they will do to prevent the cash rate from increasing, after they have basically taken some of the money from the banks, they will then purchase securities off the banks, which will basically give the money back to the banks. So essentially they'll take some of their Australian dollars and give them foreign currency, and then because they don't have enough Australian dollars, they will then purchase some of their securities at a higher rate, so therefore the banks now have more cash. So the RBA basically offsets the decrease in cash or liquidity that these banks have by giving cash back to them by purchasing securities. And that's what we call sterilised intervention. If the RBA wants to prevent the Australian dollar from rising too much, they purchase foreign currency, and so they sell Australian dollars. This is when the RBA wants to depreciate the value of the dollar. But by selling off the Australian dollar to the banks, that will increase the liquidity of the banks. So if the RBA wants to depreciate the value of the dollar, they would be selling off Australian currency to the banks and purchasing foreign currency. And now the banks will have more liquidity, more Australian dollars, and they would be likely to decrease the cash rate. So what the RBA do will, to sterilise this, they will then sell securities to these banks to basically negate that impact. So first of all, they will give Australian dollars to the banks, so the banks will have an increased supply of Australian dollars, and because they've now got too much cash, after that the RBA then needs to sell securities to these banks to decrease their stock of Australian dollars and prevent the cash rate from decreasing. That's all.